Oil prices rise as Ukrainian drone attacks damage near 12% of the Russian refining capacity. Then tensions between China and the US rise as US House passes a bill to ban TikTok in the US unless ByteDance sells its platform to someone the US likes. And overall, well, sentiment is mixed into today's US retail sales and PPI data, which will be the last piece of the puzzle before FOMC announces its latest decision next week. So welcome. This is Swissquote's Daily Market Talk. So direction was mixed yesterday as Tuesday's hotter than expected CPI print in the US gave cold feet to some investors regarding the Federal Reserve's ability to cut the interest rates as soon as in June. The S&P 500 and Nasdaq consolidated near record levels, while energy stocks helped tempering losses in the S&P 500 yesterday because the technology stocks were mostly down. Now, the dollar index also rebounded yesterday as the sell-off in US Treasuries accelerated despite a strong 30-year bond auction from the US yesterday. And today, well, focus is on the US retail sales and producer price inflation data. Now, retail sales are expected to have rebounded following a relatively weak read in the month of January, while producer prices are expected to have risen in February, fueled by higher energy prices. Normally, and I say normally, I would expect higher than expected retail sales and especially a higher than expected PPI data to temper the Federal Reserve's interest rate cut bets, back a further rise in US yields and the US dollar, and hence trigger a downside correction in the US stock markets and major US indices. But just maybe, no one will care and we will see a complete opposite reaction to the data. Who knows? Because the Tuesday's market reaction to a hotter than expected CPI data was totally unusual, and why not we would see the same thing today. But speaking of oil prices, the positive pressure is building after the EIA data confirmed a 1.5 million barrel fall in US oil inventories last week, and after Ukraine attacked major Russian oil refineries with drones that damaged around 12% of the country's oil processing capacity. Now, the barrel of US crude tested the $80 per barrel level to the upside on the news, and we could see the oil bulls clear this resistance. Yet, I doubt that we will see a sustainable rise in oil prices above this $80 per barrel level when the geopolitical jitters disappear from the headlines, because note that there is still a strong resistance within the $80 to $82 per barrel range. Copper, on the other hand, rallied higher at yesterday's trading session as option volume spiked on, bets that copper prices will continue to rise on tight supply and on softer monetary policies across the globe that could, normally fuel growth and growth expectations globally. Elsewhere, tensions between the US and China are on the rise again as the US House passed a bill to ban TikTok unless the Chinese ByteDance sells its platform to a third party that would simply comply with the US data security demands. Now, the bill is on its way to the White House and Biden will likely sign it because the US accuses China to use the user data and build propaganda using the platform, which is not China style, mind you, but just kidding. The affair is obviously highly political, and it is just one more major point that opposes the two presidential candidates to the White House this year, Mr. Joe Biden and Donald Trump. Now, Biden, as I said, says he will sign the bill, but Donald Trump says banning TikTok would give too much power to Facebook, that he openly dislikes, as Facebook imposed a ban on ex-president after the Capitol riot back in 2021. Now, Meta didn't react much to the news yesterday because investors simply await the last big economic data from the US before next week's FOMC decision and dot plot and all the forecasts. Now, some investors out there think that the rally is overdone, and it's gently time for big technology stocks to give back some of their recent gains. But most people think that the rally has further room to run and that the technology valuations in the US are not necessarily too high at the current levels. But in all cases, we know that if you pull the technology stocks out of the S&P 500, well, the picture changes dramatically. It's like removing sun from the beach, or it's like day and night is just so different, because earnings from big technology companies grew 55% last quarter. Hence, earnings for the S&P 500 grew 7.4%. But if you pull out the big technology stocks from it, the S&P 493 profits fell 1.7%. So if the S&P 500 and S&P 493 converge, well, there is a higher chance that we see the S&P 500 meet the S&P 500's equal weight index somewhere in the south. On the other hand, the Magnificent Seven are not seven anymore. We start talking about Big Six, removing Tesla. Soon it will be the Magic Five, removing Apple. And at the end, we will just say Microsoft and Nvidia. I'm saying this because, well, there's nothing magnificent about Tesla anymore. I mean, the car is still cool, it's really nice to drive, but the growth prospects for Tesla are no more. An analyst at Wells Fargo, for example, said that there will be zero growth in sales volumes this year, zero, and worse, that sales for Tesla will decline next year. So that's terrible news, guys, when you think that Tesla's PE ratio stands at around 65 today, which is way too high for a company which is no longer expected to grow at the pace of 50% per year. Because in comparison, Nvidia's PE ratio stands at 75, but the company printed a more than 200% sales growth last quarter. So Tesla fell another 4.5% yesterday. The downside risk prevail. The bears eye a further fall toward the $130-$150 range, and this time, even encouraging news from the Federal Reserve front may not change the course of the company. Anyway, elsewhere, well, the European stocks extended their gains yesterday and hit a fresh record as energy and luxury names led the rally higher at yesterday's trading session. The euro dollar, on the other hand, consolidates gains below the 110 level and should normally, and I say normally again, see a solid resistance into this level, especially if we see another hot inflation report from the US today. Now, the European Central Bank's Wunsch said yesterday that the bank may eventually start lowering its interest rates without being sure that inflation in the Eurozone is returning to the 2% target, and that the latter decision could come before so long. And listening to the ECB chief Christine Lagarde and other ECB members, it's now sounds like a June rate cut in the Eurozone is a done deal if, of course, we don't see a big surprise on the inflation front, which is not sure, by the way, given that a lot could change from now to June. I mean, if, for example, tensions between Ukraine and Russia escalate in a way to boost oil and energy prices, we will certainly see the central banks constrained to delay their interest rate cut plans further down the road. But for now, don't panic, because the expectation is that the ECB will start cutting in June and cut 4 times. The bank also announced changes yesterday to its operational framework in a way to allow the banks in different locations, different regions of the Eurozone to ask for the liquidity that they need so that the European Central Bank's monetary policy could be more flexible to better meet the various needs of various economies across the Euro area's bloc as excess liquidity dries out. Now, what's going to be the market reaction to that change? Well, the market reaction is expected to be quite limited, so do not worry about it. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.